Hello and good morning, and yes, today is Monday, August 8th, 2022, and I am Kenny Polcari, your host of the party. And what is it that we need to know today as the week begins? There's a lot going on, right? Last week, the non-farm payroll report surprised everybody. 75 basis point hikes is now back on the table in September. Oil continues to trade a little bit lower, but around the trend line. The question is, will it hold? And China taunts Taiwan, and the Senate passes a huge tax and spend bill. And what do we have for dinner tonight? We're going to have the chicken thighs with pancetta, tomatoes, and balsamic vinegar. Easy to make, and it is delicious. Okay, look, on Friday we found out that the U.S. economy added 528,000 jobs, more than double the expectation, surprising nearly everybody, including White House Press Secretary KJP, right, Karine Jean-Pierre. The report showed that the labor market is not cooling off at all, and that puts payrolls at their pre-pandemic level. Unemployment fell to 3.5%, remaining at historic lows. Average hourly earnings month over month and year over year rose more than expected, rising by 0.5% and 5.2% respectively, and that's going to continue to fuel the wage price spiral inflation conditions that exist. Labor force participation fell to 62.1%, and that is a metric that you should make sure that you understand. The labor force participation rate measures the percentage of the working age population who have a job or are actively looking for one, while the unemployment rate measures the percentage of people within that labor force that are without a job. In 2000, the labor force participation rate was as high as 67.3%, and the unemployment rate was 4%. Friday's data has the participation rate at 62.1% and the unemployment rate at 3.5%. Economists suggest that the loss of participation during this decade is a result of the baby boom generation hitting retirement age, along with lower skilled workers losing their jobs due to outsourcing and automation. Friday's decline was seen as a loss of younger workers in the 19 to 24 age group choosing not to work or moving on doing something else, living in their parents' basement, whatever. Now, the unemployment rate only considers those in the labor force, not differentiating between full and part-time workers. If you have a job full or part-time, you're considered employed. For instance, Friday's report showed that there were 384,000 part-time jobs created, right? Jobs that paid hourly wages but don't have any benefits, no health benefits or retirement benefits, but they are jobs. The unemployment rate of 3.5% means that 3.5 people out of 100 in the labor force are without jobs. It does not consider the unemployed workers who have given up even looking for a job, thus they're not counted, right? If they were counted, that rate would be much higher. So the jobs report is the exact opposite of what you think of as a slowing economy. And all that means is that we have to reconsider putting a 75 basis point hike back on the table for September. And the idea that rate cuts are coming in the new year, well, that ain't happening, at least not in the first part of the new year, if at all. Which then raises the question whether investors will continue to pay up for stocks in the weeks ahead, or have they once again gotten a bit ahead of themselves as we've seen the market rally off the lows here, right? The NASDAQ and S&P both up double digits off the lows. Now, by the end of the day on Friday, the Dow gained 77 points, the S&P lost 7, the NASDAQ lost 64, the Russell added 16, and the transports added 122 points. The Treasury curve remains inverted, with the 2s yielding 3.2%, much more than the 5s at 2.94, and much more than the 10s at 2.81. And that is always a signal of a coming recession. On Friday, though, Cleveland Fed President Loretta Mester had this to say about the yield curve, and I quote, "I don't think that the yield curve, which actually inverts and flattens going into every recession in modern history, so 79, 81, 90, 2000, 08, and 19, is a good predictor of where the economy is headed," which just means that they're trying to change the narrative of that. Suddenly, an inverted yield curve doesn't tell us anything at all, which is comical since it told us everything every time it happened in the past, much like a recession, which has a very clear definition, one that has been used for decades until it wasn't. And look at this. NPR reported that Wikipedia had to freeze edits to its recession page because so many people were apparently trying to redefine it so that it fits the current narrative. I mean, you can find the link if you just Google NPR.org. It's on there. The article was written on July 29th. But if you really want the meat and potatoes of it, you really just have to listen. You really just have to listen to this because this says it all, right? Wikipedia has frozen the ability to edit its page for recession, halting a frenzy of changes to the entry after the Biden administration insisted that the U.S. economy has not entered an economic downturn. Right? So everyone went in there because, with Wikipedia, you can edit the post. Now, that essentially means that they're trying to change a definition on the Wikipedia page. Now the question is, who exactly was trying to edit the definition? Who was trying to change the definition that has stood for millennium about what a recession is, right? The freeze ended on August 3rd, though, and today's August 8th. So I wonder what happens now. Will we get a new definition of what a recession is on Wikipedia, or won't we? And then I wonder what they're going to do about the yield curve inversion page, because that surely is going to change too after Loretta Mester's comment, and that simmers through the narrative, right? Defining what a yield curve really means. Next up, we got the corporate earnings, and as you know, we're winding down the season, and so far, the current set of earnings has mostly been in line with the expectations, helping to stabilize the markets. That's good. But forward guidance has been cautious, and that's going to cause analysts to have to revise downward estimates for the third and fourth quarters. We've been talking about it. And it appears that they're already doing it at a faster pace than usual, which just means we need to brace for more chop ahead as the estimates get reset and investors reprice stocks based on those new estimates and what they think the state of the economy is. Third quarter estimates have already been revised downward by 2.5%, according to FactSet. And this was only in July. Just wait until we get into September. Analysts always get busier slashing expectations just ahead of the reporting season that begins in early October to make sure that they cut them enough so that when the earnings are announced, they beat the expectations at a rate of 70+%. The S&P is now trading at 18 times expected earnings, right? 41.45, which the S&P divided by 230, which is the expected S&P earnings this year, that equals 18. That's up from 15.5 that we saw in June when the S&P was trading at 36.25. If analysts cut third and fourth quarter estimates, then year-end targets have to change. And that's going to cause valuations to change, and that will cause you to ask, what are investors willing to pay for earnings in a rising rate environment, right? It's a math problem. Is it still 18 times, or does it revert to the 10-year average of like 14.7? And if that's the case, then the S&P should end the year at 33.80. So much will depend on what the Fed does, the pace at which they do it, so sit tight. The story is far from over. Recall, our friends at Goldman think that we're going to test S&P 3100 before we find a bottom. And that represents a 25% drop from here. Oil ended the week at $89 a barrel after testing as low as 87, piercing its long-term trend line at 88.88. A level I pointed out would be the key to the next long-term move. If oil cannot take back the trend line, then the expectation is it's going to test lower still, like in the 80-85 range. This morning, oil is up 20 cents at 89.20, just enough to hold the line, but not up with any real conviction. And talk of an economic slowdown that they've been yapping about will surely send oil lower, which is a double-edged sword, right? Because low prices are good, but are they lower because of demand destruction and a recession, or are they lower because of more production and supply? And here's the hint. It ain't option 2, that's for damn sure. And China, well, over the weekend, they kept the heat on Taiwan. Beijing has also cut products marked with the Made in Taiwan or Made in ROC sticker, as well as cutting off contacts with the U.S. on vital military issues and climate cooperation, all while launching missiles aimed at Taiwan, which conveniently missed the island, but, it's the threat of the missiles flying over the island. And all this is doing is raising the temperature in the room. Now, I know you say that Pelosi had every right to go, blah, 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 blah. And I'm not suggesting that she didn't, but I would ask, what did the trip accomplish? What did she accomplish? She confirmed that the U.S. stands with Taiwan. Okay, great. That's not new information. But what does it really mean? Are we going to war with China when Xi makes his move on Taiwan? Is that what she meant? All while the White House and the Pentagon spokesman John Kirby reminded us that we respect the one China policy and that we do not support an independent Taiwan? So what does it mean? It's all chaos and confusion. It's enough to kind of change a narrative and take your eyes off of what's happening. Remember, Geopolitical drama doesn't price stocks in the long term. It does create short-term confusion and chaos, and until it simmers down, it can boil over, right? So you have to kind of manage where that goes. Gold, which traded up and through trendline resistance at 1807 last week, failed to hold, ending the week at 1790 an ounce. This morning it's down about $3 at 1788. This after the strong NFP report eased recession worries, raising the prospect of more rate hikes to tamp down inflation. And if inflation subsides, then gold becomes less attractive. But if it doesn't subside, then gold becomes more interesting. In addition, talk of China not being even more aggressive in response to the Pelosi visit is helping to ease that move, which I think is just temporary. You know how I feel. I think gold is poised to go higher, and we'll get more information this week when we get the CPI and the PPI reports, which are the macro data points coming. For now, it remains in the 1780, 1811 trading range, right? It should find plenty of support at the 1780 level. Anyway, Dow futures, which were lower overnight, have all turned higher, right? The Dow futures up 60, S&P's up 8, the Nasdaq up 40, the Russell's up 4, as we are about to open. Investors had the weekend to consider what the Fed will do next, post that strong NFP report, which should make some people reconsider the state of the economy. The job market is strong, according to the NFP, and that lowers the expectation that a recession is upon us. So the sense is that another aggressive rate hike in September is squarely back on the table, right? 75 basis point now has to be back on the table. And in fact, Fed futures are now pricing that back in. Economic data today includes nothing, but later in the week, we're going to get the CPI, the PPI, consumer sentiment, and 2 Fed speeches, right? Minneapolis Fed President Neely Kashkari and Chicago's Chucky Evans, both non-voting members of the FOMC. But they're going to surely have lots to say, so stick close because, are they saying it, floating the balloons to see how the market reacts? That's what you always have to think. This morning we get earnings from Dominion Resources, Palantir, Tyson Foods, and AIG. We're going to get more as the week progresses, but we've now heard from 430 of the S&P 500 names. So the bulk of it is done, and we know how the story plays out. 77% of reports have beat on the bottom line, while 70% have beat on the top line. And that's being viewed as okay, considering what many expected going into the season. But look, stay close. Third quarter revisions have only just begun. European markets are all higher, up by about 0.5% to 0.8% across the board. There's nothing new there. No specific macro news. It's just all about earnings and the Fed and inflation and the ECB. It's the same old stuff. Yesterday afternoon, we saw that the Senate voted to pass the Inflation Reduction Bill. Kamala had to cast a deciding vote, and boom, it was done. The bill is the latest tax, climate, and healthcare bill that is supposed to reduce the deficit 10 years out. Not tomorrow, not this year, not next year. It's not supposed to happen until the end of the decade, right? It promises to allow the government to negotiate lower prices on 20 meds beginning in the year 2026. So 4 years out. And then again in 2029. That's great. But all that means is that drug prices for the rest of us are only going to go up in 2023 to offset the expected losses at Medicare in 2026, right? That Medicare is going to impose on them by trying to negotiate prices low. So expect prices to go higher for everyone else, and they're going to go higher immediately. It also means more IRS agents. The bill provided $80 billion to the agency, and that means get ready for more audits, as these new agents will be tasked with coming after you to find out that you took a small questionable deduction and then slam you with fines and fees. The Dems say, oh, no, don't worry. They're going after the big boys, not the middle class. No need to worry. Of which I say that's comical. That's laughable. How they can even stand up and say that, because watch what's going to happen. The S&P closed at 41.45 after testing a low of 41.07 and a high of 41.51. Wednesday and Thursday are going to be the days to watch, right? Wednesday brings us July CPI, which is expected to be a bit lower on the core number, but higher when you remove food and energy year over year. PPI is on Thursday, and that's expected to be a bit lower, but still elevated at 10.4% year over year, which remains high. Last week's strong NFP report, coupled with the higher wages, puts the Fed kind of in this awkward position about what to do with rates, and the messages being delivered by many of the Fed members remains confused, right? The Fed's Jackson Hole boondoggle takes place at the end of this month, because remember, there is no FOMC meeting. So expect the speculation to be all about what JJ might say that is different from what we already know. And then we get hit with the September-October timeframe, which is typically a tougher time for the markets. While I remain bullish on the broader market going into year end, I remain cautious over the next 2 months. And all that means is opportunities are ahead. Okay, so what are we having for dinner tonight? This is really a simple dish. It doesn't take a whole lot to put together, and then it just roasts in the oven, right? Roast on the, excuse me, not in the oven, on the pan right on the stove, right? It kind of braises. It's chicken thighs with pancetta, tomatoes, and balsamic vinegar. I know it doesn't sound interesting, but it is very interesting. And so for this, you need the olive oil. You need diced pancetta. You can use bacon if you have it. You need 8 medium-sized skinless chicken thighs. You need onion, white onion, right, diced. You need garlic cloves, chopped and peeled. You need dry red wine, a can of diced tomatoes, and a can of tomato paste, water, chopped rosemary, chopped thyme, salt and pepper, red hot pepper flakes if you want, those are optional, and balsamic vinegar, and then chopped fresh parsley. Now, in a large, heavy skillet, enough that's going to accommodate all the chicken, you want to heat a little bit of oil over medium heat and then cook the pancetta until it's cooked through and lightly brown. Don't burn it, just crisp it up. Should take you no more than 5 minutes. Remove the pancetta, set it on a plate. Now take the thighs, put those in the saute pan and brown them on all sides. It should take you about 10 minutes to, kind of brown them a little bit and cook them. Remove the chicken, put those on the plate. Now add the onions to the saute pan, saute them until they're translucent, 5 to 8 minutes. Now add the garlic. Cook that for another 3 minutes or so, let it kind of all blend. Now add about a half a cup of your red wine. Increase the heat to medium-high heat and cook just until the wine is reduced by half. Now you're going to add the can of tomatoes, the tomato paste. You're going to add a can of water, a tomato paste can of water. You're going to add the chopped rosemary, chopped thyme, salt, pepper, and the red pepper flakes if you're using them. Bring it all to a boil. Then put it down to simmer. Now take the chicken and the pancetta and put it back in the saute pan. Put it on simmer and cover the pan. Simmer it for 20 minutes or so until the sauce has thickened, right? Adding additional water if the sauce thickens too much, you want to add a little bit of water. Don't make it watery, but don't make it really thick, right? Taste and adjust. Yes, taste and adjust with salt and pepper as needed. Now stir in about 1 tablespoon of balsamic vinegar. Mix it well. Present the chicken on a platter. Top it with the sauce, and then sprinkle the chopped fresh parsley all on top of it when you serve it, right? It's a great family-style dish. It's also a great dish if you're going to have a summer barbecue. Put it out there on a plate with the sausage and peppers and with the steaks and whatever else you're making, the salads, all different kinds of salads you're going to make, and then certainly the watermelon for dessert. As we are now in the waning weeks of summer, right? We're now into the second full week of August. It's before you know it, it's going to be Labor Day. In any event, look at this. It is beautiful outside, a little bit humid here in South Florida, but I'm not worried about it. Until tomorrow, take good care.